Last month, I made 47% returns while my friend lost his entire 25,000 rupees investment. We both traded the same stock, but I used a strategy he had never heard of. The difference? I understood options trading, and he was just gambling. Welcome back to the channel, and today I'm going to show you exactly how options work so you never make his costly mistake. Today we're diving deep into options trading, and I'm going to break down everything you need to know in the simplest way possible. By the end of this video, you will understand exactly how options work, how to calculate your profits, and most importantly, how to avoid the mistakes that cost beginners their hard-earned money. But before we start, if you're serious about learning smart money strategies, hit that subscribe button and press the bell icon twice for all notifications. It's completely free and helps me create more valuable content like this for you. But first, let me share something that might shock you. Last month, I made 47% returns on a single options trade while the stock only moved 8%. How is this possible? It's all about leverage, and I'll show you exactly how this works. Let's start with the absolute basics. An option is simply a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price within a certain time period. Think of it like booking a movie ticket online. You pay a small fee upfront, and this gives you the right to watch the movie, but you don't have to actually go if you don't want to. There are two types of options: calls and puts. A call option gives you the right to buy a stock at a fixed price. A put option gives you the right to sell a stock at a fixed price. Let me explain this with a real example using Reliance Industries currently trading at 2,500 rupees. Let's say you believe Reliance will go up in the next month. Instead of buying 100 shares for 2.5 lakh rupees, you could buy a call option for just 15,000 rupees. This call option gives you the right to buy Reliance at 2,550 rupees anytime in the next month. Now, if Reliance moves to 2,650 rupees, your shares would have made you 15,000 rupees profit on a 2.5 lakh investment. That's 6% return, but your call option would now be worth at least 100 rupees per share times 100 shares, which is 10,000 rupees. Since you paid 15,000 for the option, you're currently at a loss. But here's where it gets interesting. Let's say Reliance moves to 2,750 rupees. Your call option is now worth 200 rupees per share, or 20,000 rupees total. You paid 15,000, so your profit is 5,000 rupees on a 15,000 investment. That's 33% return, while the stock only moved 10%. This is the power of leverage in options. But here's the catch. If Reliance stays below 2,550 rupees or doesn't move much, your entire 15,000 rupees investment could become worthless. This is why 80% of option buyers lose money. Now, let's understand the 4 key factors that determine an option's price. These are called the Greeks, and understanding them is crucial for success in options trading. First is delta. Delta tells you how much the option price will change when the stock price changes by 1 rupee. If a call option has a delta of 0.5, it means for every 1 rupee increase in the stock price, the option price will increase by 50 paise. Options closer to the current stock price have higher deltas, typically between 0.4 to 0.6. Second is gamma. Think of gamma as the speed at which delta changes. If delta is the speed of a car, gamma is the acceleration. Options that are close to the current stock price have the highest gamma, meaning their delta changes rapidly as the stock price moves. Third is theta, and this is the option killer. Theta represents time decay, how much value the option loses each day. Every day that passes, your option loses money due to theta, even if the stock price doesn't move. This is why buying options is like a melting ice cube. Time is working against you. Fourth is Vega, which measures how much the option price changes when volatility changes. During news events or earnings announcements, volatility increases and option prices go up. After the event, volatility drops and option prices fall even if the stock price doesn't change much. Let me show you how to calculate break-even points because this is where most beginners get confused. For a call option, your break-even point is the strike price plus the premium you paid. Using our Reliance example, strike price 2,550 plus premium 150 equals break-even of 2,700 rupees. The stock needs to move above 2,700 for you to make money. For put options, it's the opposite. If you buy a put option on Reliance with a strike price of 2,450 rupees and pay a premium of 120 rupees, your break-even is 2,450 minus 120, which equals 2,330 rupees. The stock needs to fall below 2,330 for you to profit. Now, here's the strategy that helped me make 47% returns. Instead of just buying options, I started selling them. When you sell a call option, you collect the premium upfront and you keep it if the stock doesn't move above the strike price. This is called a covered call strategy. Here's how it works. I owned 100 shares of HDFC Bank at 1,600 rupees. I sold a call option with a strike price of 1,700 rupees and collected a premium of 80 rupees per share, which is 8,000 rupees. If HDFC Bank stays below 1,700 rupees, I keep the 8,000 rupees premium. If it goes above 1,700, I sell my shares at 1,700 plus, keep the 8,000 premium. On a 1.6 lakh investment, collecting 8,000 rupees premium in 1 month gives me a 5% monthly return, which compounds to about 60% annually. The key is to do this consistently on stocks you already own. For beginners, I recommend starting with cash secured puts. This means you sell a put option on a stock you want to own and you keep the cash ready to buy the stock if needed. Let's say you want to buy TCS at 3,200 rupees, but it's currently trading at 3,400 rupees. You sell a put option with a strike price of 3,200 rupees and collect a premium of 150 rupees per share. If TCS stays above 3,200, you keep the 15,000 rupees premium. If TCS falls below 3,200, you get to buy the stock at 3,200, but since you collected 150 rupees premium, your effective purchase price is 3,050 rupees. Now, let me share the biggest mistakes that cost beginners money. First, buying options just before expiry. Time decay accelerates in the last week and options lose value rapidly. Second, not having a profit target. Many traders hold winning positions too long and watch them turn into losses. Third, risking too much on a single trade. Never risk more than 2% of your portfolio on any single options trade. Fourth, ignoring volatility. Buying options when volatility is high means you're paying inflated prices. Fifth, not understanding the Greeks. Many beginners focus only on the stock price direction and ignore time decay and volatility changes. Here's your action plan to start options trading safely. First, open a trading account with a broker that offers good options education and low brokerage. Second, start with paper trading or very small amounts to understand how options behave. Third, focus on liquid options with tight bid-ask spreads. Fourth, master one strategy before moving to complex ones. And if this breakdown is helping you understand options better, show some love by hitting that like button and sharing this video with someone who needs to learn about smart investing. Your support means everything to me. Fifth, always calculate your maximum loss before entering any trade. Sixth, set profit targets and stop losses. Seventh, keep learning about different strategies like bull call spreads, bear put spreads, and protective puts. Remember, options are powerful tools, but they're also risky. The key to success is education, practice, and risk management. Start small, learn from each trade, and gradually increase your position sizes as you gain experience. If you found this video helpful, hit that subscribe button and ring the notification bell so you never miss any of my finance videos. Also, let me know in the comments which option strategy you want me to explain next. I read every comment and use your feedback to create more valuable content. Before you go, here's a quick reminder. Options trading is not gambling if you understand the math and manage your risks properly. Treat it like a business, keep detailed records of your trades, and always remember that preservation of capital is more important than making quick profits. That's all for today's video. Until next time, keep learning, keep investing, and keep building your wealth systematically. See you in the next one.